Look, I need you to imagine something for a second. You're scrolling through your phone, you see someone posting about their stock portfolio being up 30% this year, and you think to yourself, I should probably get into this. So you open up your brokerage app, you stare at all these terms, P/E ratio, market cap, dividend yield, bull market, bear market, and you freeze. You close the app. You tell yourself you'll figure it out later. And here's the thing, later never comes because the language of the stock market feels like it was designed to keep regular people out. That stops today. My name is Tom, and I spend way too much time thinking about why financial literacy isn't actually taught in schools, even though it's literally the skill that determines whether you retire comfortably or work until you're 75. If you're someone who knows you should be investing but feels completely lost every time you try to research stocks, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's what most people don't realize. The stock market isn't complicated because investing is inherently difficult. It's complicated because the financial industry benefits from you feeling confused. A study from the National Financial Educators Council found that the average American loses around $1,500 per year due to a lack of financial literacy. That's $18,000 over 12 years. That's a decent used car you're just leaving on the table because nobody explained what a stock actually is. So let's fix that right now. A stock, at its most basic level, is ownership in a company. When you buy one share of Apple, you own a tiny piece of Apple. Now, you might be thinking, okay, Tom, I get that, but what does that actually mean? Here's where it gets really interesting. That ownership gives you two potential ways to make money. The first is capital appreciation, which is just a fancy way of saying the stock price goes up. If you buy a share for $100 and sell it for $150, you made $50. Simple. The second way is dividends, which are payments companies make to shareholders out of their profits. Some companies pay dividends, some don't, and we'll get into why that matters in a minute. But here's the psychological shift most beginners miss. When you own stock, you're not just gambling on a ticker symbol going up or down. You're betting on a business. You're saying, I think this company will be worth more in the future than it is today. That's a completely different mental framework than treating the stock market like a casino. And it's the difference between people who build wealth and people who lose their shirt day trading based on Reddit posts. Now let's talk about shares. A share is just the unit of stock. If a company has 1 million shares and you own 1,000 of them, you own 0.1% of that company. Companies decide how many shares to issue, and this number matters more than you think. Here's why. Let's say Company A and Company B are both worth $1 billion in total. Company A has 10 million shares, so each share is worth $100. Company B has 100 million shares, so each share is worth $10. Beginners see the $10 stock and think it's cheaper or a better deal, but that's completely wrong. The share price by itself tells you nothing. What matters is the total value of the company and what you're getting for your money. This brings us to market capitalization, or market cap, which is probably the single most important term you need to understand. Market cap is the total value of all of a company's shares combined. You calculate it by multiplying the share price by the number of shares outstanding. So if a company has 10 million shares and each share costs $50, the market cap is $500 million. That's what the entire company is worth, according to the stock market right now. Companies are grouped by market cap into categories. Small cap companies are generally worth between $300 million and $2 billion. Mid cap companies are worth between $2 billion and $10 billion. Large cap companies are worth over $10 billion. And then you have mega cap companies like Apple, Microsoft, Google, which are worth over $1 trillion. Here's what nobody tells you about this. Small cap stocks are generally riskier, but have more room to grow. A company worth $500 million could realistically double to $1 billion. But a company worth $2 trillion, that's not doubling anytime soon. The psychological mistake investors make is treating all stocks the same when a small cap tech startup and Apple are completely different investment profiles. Let's talk about stock exchanges. because this confuses people. The New York Stock Exchange and NASDAQ are the two big ones in the United States. They're basically marketplaces where buyers and sellers come together to trade stocks. The New York Stock Exchange is the older, more traditional one, where stocks are traded on a physical floor with actual human market makers. NASDAQ is fully electronic. But here's the thing. It doesn't really matter which exchange a stock is on for you as an investor. What matters is that these exchanges provide liquidity, which means there are enough buyers and sellers that you can actually sell your stock when you want to. Imagine owning a house in a town where nobody wants to buy houses. You might own something valuable, but you can't convert it to cash. Liquidity solves that problem. Now, you might be thinking, okay, but how does the price of a stock actually move? This is where it gets fascinating. Stock prices move based on supply and demand, just like anything else. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. But here's the deeper question. What makes people want to buy or sell? Sometimes it's rational. A company reports better than expected earnings, so people think it's worth more and buy. Sometimes it's completely irrational. A celebrity tweets about a stock and it goes up 20% for no fundamental reason. This is why you need to understand the difference between trading and investing. Trading is short term. You're trying to profit from price movements over days, weeks, maybe months. You're essentially trying to predict human psychology and market timing. Investing is long term. You're buying ownership in businesses you believe will be worth more in 5, 10, 20 years. Here's a stat that should blow your mind. According to research from Dalbar, the average equity investor earned 5.5% annually over the 20 years ending in 2019, while the S&P 500 returned 7.2%. That gap exists because people try to time the market. They panic sell during downturns. They chase hot stocks. They trade too much. The market went up 7.2% on average, but the average investor only captured 5.5% because of behavioral mistakes. Let's get into valuation metrics, because this is where beginners get completely lost. The P/E ratio, or price to earnings ratio, is the most common valuation metric. It tells you how much you're paying for each dollar of earnings. If a stock is trading at $50 per share, and the company earns $2.50 per share annually, the P/E ratio is 20. You're paying $20 for every $1 of annual earnings. Now here's the psychological trap. Beginners see a low P/E ratio and think it's a bargain. They see a high P/E ratio and think it's overpriced. But that's overly simplistic. A low P/E ratio might mean the stock is undervalued, or it might mean investors think the company's earnings are about to collapse. A high P/E ratio might mean the stock is overpriced, or it might mean investors believe earnings are about to explode. Tech companies often have high P/E ratios because people are betting on massive future growth. Utility companies often have low P/E ratios because their earnings are stable but not growing fast. Context matters. Here's a concrete example. Let's say company X has a P/E ratio of 10, and company Y has a P/E ratio of 40. Your gut says, buy company X. It's cheaper. But what if company X is in a dying industry and its earnings are declining 10% per year, while company Y is in a booming industry and its earnings are growing 50% per year? Suddenly, that high P/E ratio makes sense. You're paying more now because the company will be worth way more in the future. The earnings per share, or EPS, is exactly what it sounds like. It's how much profit the company makes divided by the number of shares. If a company makes $10 million in profit and has 5 million shares, the EPS is $2. Companies report this quarterly and annually, and investors obsess over whether companies beat or miss earnings expectations. Here's what's wild. A company can report great earnings, and the stock can still go down if those earnings weren't as great as investors expected. The stock market doesn't trade on reality. It trades on expectations versus reality. Dividends are one of the most misunderstood concepts in investing. A dividend is a cash payment a company makes to shareholders, usually quarterly. Let's say you own 100 shares of a company, and they pay a $1 annual dividend per share. You get $100 per year just for owning the stock. Sounds great, right? But here's the catch. When a company pays a dividend, the stock price drops by the amount of the dividend on the ex-dividend date. If a stock is trading at $50 and pays a $1 dividend, the stock opens at $49 after the dividend is paid. You're not getting free money, you're just getting your own money back in a different form. So why do dividends matter? Because they force companies to return cash to shareholders instead of hoarding it or wasting it. Dividend-paying stocks also tend to be more stable, mature companies. But here's the psychological mistake. Beginners chase high dividend yields without understanding the risk. The dividend yield is the annual dividend divided by the stock price. If a stock pays $4 per year in dividends and trades at $100, the yield is 4%. If that stock drops to $50 and still pays $4, the yield is now 8%. That looks amazing until you realize the stock price might be crashing because the company is in trouble and about to cut its dividend. Let's talk about stock buybacks, because this is something most beginners don't even know exists. A buyback is when a company uses its cash to buy its own shares on the open market and retire them. This reduces the number of shares outstanding, which increases the ownership percentage of remaining shareholders and usually boosts the stock price. Here's a real-world example. Let's say a company has 10 million shares worth $10 each, so a market cap of $100 million. The company buys back 1 million shares and retires them. Now there are 9 million shares. If the company is still worth 100 million total, each share is now worth $11, 11 cents. Shareholders benefit without receiving any cash. Now here's where it gets controversial. Some people argue buybacks are great because they return value to shareholders in a tax-efficient way. Others argue companies use buybacks to artificially inflate their stock prices instead of investing in their business or paying workers more. Both can be true. What matters for you as an investor is understanding that buybacks are a form of shareholder return just like dividends. Bull markets and bear markets are terms you hear constantly, but let's actually define them. A bull market is when stock prices are rising or expected to rise. Generally, it's defined as a 20% increase from recent lows. A bear market is when stock prices are falling or expected to fall, generally defined as a 20% decline from recent highs. The average bull market since 1950 has lasted about 4.5 years, with an average gain of 154%, according to data from First Trust. The average bear market has lasted about 9.6 months, with an average loss of 32.5%. Here's the psychological trap that destroys beginners. Bear markets feel way worse than bull markets feel good. Losing 30% of your portfolio in 6 months is emotionally devastating. Gaining 30% over 18 months feels nice but not euphoric. This is called loss aversion, and it's why people panic sell at the bottom. They can't stand the pain of watching their account value drop, so they sell, lock in their losses, and then miss the recovery. According to a study by Charles Schwab, investors who stayed invested through the 2008 financial crisis and the recovery through 2018 saw an average return of about 8% per year. Investors who sold during the crisis and stayed in cash earned basically nothing. Let's get into order types because this is super practical. A market order is when you buy or sell a stock immediately at the current market price. You're saying, I want this stock right now. I don't care about the exact price. A limit order is when you set a specific price you're willing to pay or accept. If you set a limit order to buy at $50, your order only executes if the stock reaches $50 or below. This gives you price control, but you might not get the stock if it never reaches your price. Here's a real scenario. Let's say a stock is trading at $100. You place a market order to buy 100 shares. In the seconds it takes for your order to execute, the price jumps to $102 because there's high demand. You just paid $200 more than you expected. If you had used a limit order at $100, your order wouldn't have filled, but you wouldn't have overpaid either. For liquid stocks like Apple or Microsoft, this rarely matters. For small cap stocks with low volume, it can cost you serious money. Stop loss orders are a risk management tool. You set a price below the current market price, and if the stock drops to that level, it automatically sells. Let's say you buy a stock at $100 and set a stop loss at $85. If the stock drops to $85, it sells automatically, limiting your loss to 15%. Sounds great in theory, but here's the problem. Stocks fluctuate. A stock might drop to 85 during a temporary panic, trigger your stop loss, then bounce back to 110. You locked in a loss right before the recovery. The bid and ask prices confuse people, but they're simple. The bid is the highest price a buyer is willing to pay right now. The ask is the lowest price a seller is willing to accept right now. The difference is called the spread. For popular stocks like Amazon, the spread might be 1 cent. For small, illiquid stocks, the spread might be 50 cents or more. This matters because when you buy, you pay the ask, and when you sell, you receive the bid. You're losing money to the spread on every trade. Here's a concrete example. A stock has a bid of $10 and an ask of $10.20. You buy 100 shares at $10.20, paying $1,020. Immediately, if you wanted to sell, you'd only get $10 per share, receiving $1,000. You're down $20 before the stock even moves. This is why day trading is so hard. You're fighting the spread on every single trade. Volume is the number of shares traded during a specific period, usually a day. High volume means lots of buying and selling activity. Low volume means not many people are trading. Volume matters for a few reasons. High volume usually means more liquidity, so it's easier to buy and sell without moving the price. Unusual volume spikes can signal something is happening. Maybe news, maybe a rumor. If a stock normally trades 1 million shares per day and suddenly trades 10 million shares, something changed. Let's talk about volatility, which is how much a stock price fluctuates. High volatility means big price swings up and down. Low volatility means stable, predictable price movements. Tech stocks tend to be volatile, utility stocks tend to be stable. Here's the psychological challenge. Beginners say they want to make money fast, so they buy volatile stocks. Then the stock drops 15% in 2 days, and they panic. Volatility cuts both ways. You can't have the possibility of big gains without the possibility of big losses. Beta is a measure of a stock's volatility compared to the overall market. A beta of 1 means the stock moves in line with the market. A beta of 1.5 means the stock is 50% more volatile than the market. If the market goes up 10%, a stock with a beta of 1.5 would be expected to go up 15%. If the market goes down 10%, that stock would be expected to go down 15%. A beta below 1 means the stock is less volatile than the market. Conservative investors look for low beta stocks. Aggressive investors look for high beta stocks. Now, let's get into index funds and ETFs, because this is arguably the most important thing a beginner can understand. An index fund is a mutual fund, or ETF, that tracks a specific market index, like the S&P 500, which is the 500 largest publicly traded companies in the United States. When you buy an S&P 500 index fund, you're buying tiny pieces of all 500 companies at once. This gives you instant diversification. Here's why this matters. If you buy individual stocks, you're taking company-specific risk. If you buy 10 stocks and one company goes bankrupt, you lose 10% of your portfolio. If you buy an S&P 500 index fund and one company goes bankrupt, it barely moves the needle because you own 499 others. Warren Buffett, literally one of the greatest investors of all time, has said most people should just buy a low-cost S&P 500 index fund and hold it forever. According to his own instructions for his estate, 90% of his wife's inheritance should go into an S&P 500 index fund. Here's the stat that should convince you. Over the 15-year period ending in 2020, 89.4% of actively managed large-cap mutual funds underperformed the S&P 500, according to the S&P indices versus active scorecard. Professional fund managers, people whose full-time job is picking stocks, fail to beat a simple index fund almost 90% of the time. And they charge you 1% or more per year in fees for that underperformance. Meanwhile, index funds charge as little as 0.03% per year. Let's do the math on fees, because this is where people lose huge amounts of money without realizing it. Let's say you invest $10,000 and earn 7% annually for 30 years. With a 0.1% fee, you end up with $72,300. With a 1% fee, you end up with $57,400. That's a difference of almost $15,000 on a $10,000 investment, just from fees. Now scale that to a $200,000 portfolio, and the difference is hundreds of thousands of dollars over a lifetime. ETFs, or exchange-traded funds, are similar to mutual funds, but they trade on stock exchanges like individual stocks. This means you can buy and sell them throughout the day, whereas mutual funds only trade once per day after the market closes. Most index funds are now offered as ETFs because they're more flexible and often have lower costs. Diversification is the idea that you shouldn't put all your eggs in one basket. If you invest everything in one stock, you're taking massive risk. If that company fails, you lose everything. If you spread your money across hundreds or thousands of companies, your risk is much lower. But here's what people get wrong. They think owning 10 different tech stocks is diversification. It's not. If the tech sector crashes, all 10 stocks go down together. True diversification means spreading across sectors, industries, geographies, asset classes. Sectors are categories of the economy like technology, healthcare, financials, energy, consumer staples. Different sectors perform well at different times. During an economic boom, consumer discretionary and tech often do great. During a recession, consumer staples and utilities hold up better because people still need food and electricity. Understanding sectors helps you understand why your portfolio moves the way it does. Bonds are basically loans you make to companies or governments. When you buy a bond, you're lending money and receiving regular interest payments, plus your principal back at maturity. Bonds are generally less risky than stocks, but also offer lower returns. A balanced portfolio usually includes both stocks and bonds. Young investors can afford to take more risk, so they might be 90% stocks and 10% bonds. Older investors nearing retirement might be 50-50 or even more bonds than stocks because they can't afford to lose a huge chunk of their savings right before they need it. Asset allocation is how you divide your portfolio among different asset types like stocks, bonds, real estate, cash. This is arguably more important than which specific stocks you pick. A study by Brinson, Hood, and Bieboer found that over 90% of a portfolio's return variability comes from asset allocation, not from picking individual securities or timing the market. Most beginners obsess over which hot stock to buy when they should be thinking about their overall allocation. Dollar cost averaging is an investing strategy where you invest a fixed amount of money at regular intervals, like $500 every month, regardless of what the market is doing. This removes the emotion and timing risk. When prices are high, your $500 buys fewer shares. When prices are low, it buys more shares. Over time, you average out the price you pay. This is perfect for beginners because you don't have to figure out if now is a good time to invest. You just invest consistently. Here's a psychological insight. The hardest time to invest is when the market is crashing and everyone is panicking. But that's actually the best time because stocks are on sale. Dollar cost averaging forces you to invest during those scary times because you're investing automatically every month, regardless of how you feel. Compound interest is the eighth wonder of the world, according to Einstein. Maybe he said it, maybe he didn't, but the concept is real. Compound interest is when you earn returns on your initial investment plus returns on your previous returns. Here's a simple example. You invest $10,000 and earn 10% in year one, so you have $11,000. In year two, you earn 10% on $11,000, which is $1,100, giving you $12,100. In year three, You earn 10% on $12,100. Each year, your returns are bigger because your base is bigger. Here's the math that shows why starting early matters so much. Person A invests $5,000 per year from age 25 to 35, then stops. That's $50,000 total invested. Person B invests $5,000 per year from age 35 to 65, investing $150,000 total. Assuming 7% annual returns at age 65, Person A has $602,000 and Person B has $550,000. Person A invested 1/3 as much money, but ended up with more because they started 10 years earlier. Those extra 10 years of compounding made all the difference. Capital gains are the profits you make when you sell an investment for more than you paid. If you buy a stock for $1,000 and sell it for $1,500, you have a $500 capital gain. Here's what matters for taxes. Short-term capital gains are profits on investments held for less than 1 year, and they're taxed as ordinary income, which could be as high as 37% depending on your tax bracket. Long-term capital gains are profits on investments held for more than 1 year, and they're taxed at preferential rates of 0, 15, or 20% depending on your income. This is a massive difference. Let's say you make a $10,000 profit. If it's short-term and you're in the 24% tax bracket, you pay $2,400 in taxes and keep $7,600. If it's long-term and you're in the 15% capital gains bracket, you pay $1,500 in taxes and keep $8,500. That's $900 more just for holding one extra day past the 1-year mark. This is why buy and hold investing isn't just psychologically easier, it's also way more tax efficient. Rebalancing is adjusting your portfolio back to your target allocation. Let's say you want to be 70% stocks and 30% bonds. After a great year for stocks, you're now 80% stocks and 20% bonds. Rebalancing means selling some stocks and buying bonds to get back to 70-30. This forces you to sell high and buy low, which is exactly what you should be doing, but emotionally feels wrong. The 52-week high and low are exactly what they sound like, the highest and lowest prices a stock has traded at over the past year. Some investors use these as reference points. If a stock is near its 52-week low, maybe it's a bargain, or maybe there's a reason it's down. If it's near its 52-week high, maybe it's overvalued, or maybe it's breaking out to new highs because the business is doing great. These numbers provide context, but aren't buy or sell signals by themselves. Resistance and support levels come from technical analysis. Support is a price level where a stock tends to stop falling because buyers step in. Resistance is a price level where a stock tends to stop rising because sellers step in. If a stock bounces off $50 multiple times, $50 is a support level. If it keeps getting rejected at $70, $70 is resistance. Some people swear by this stuff, others think it's nonsense. The reality is, it becomes a self-fulfilling prophecy because enough people believe in it and trade based on it. Fundamental analysis is evaluating a stock based on the underlying business. Things like revenue growth, profit margins, competitive advantages, management quality, industry trends. This is what long-term investors focus on. They're asking, is this a good business worth owning? Technical analysis is evaluating a stock based on price charts, patterns, volume, momentum indicators. Technical analysts don't care about the business. They're looking at the chart and trying to predict future price movements based on historical patterns. Day traders and short-term traders use this approach. Here's my take. For beginners, fundamental analysis is way more useful. You're trying to build wealth over decades, not make a quick profit this week. Understanding whether a business is good or bad is more reliable than trying to predict if a chart pattern means the stock will go up tomorrow. Short selling is when you borrow shares, sell them, hope the price drops, buy them back cheaper, and return them profiting from the decline. Here's an example. You borrow 100 shares trading at $50 and immediately sell them, collecting $5,000. The stock drops to $30. You buy 100 shares for $3,000. return them to whoever you borrowed from, and keep the $2,000 difference as profit. This sounds great, except if you're wrong and the stock goes up, your losses are unlimited. If the stock goes to $100, you have to buy shares for $10,000 to return them, losing $5,000 on your original $5,000 position. Beginners should not short sell, period. Margin trading is borrowing money from your broker to buy more stock than you could with just your cash. If you have $10,000 and your broker offers 50% margin, you can buy $20,000 worth of stock. If that stock goes up 20%, you make $4,000 instead of $2,000. Sounds awesome. But if it goes down 20%, you lose $4,000 instead of $2,000, and you still owe interest on the borrowed money. Margin amplifies both gains and losses, and it's how people blow up their accounts. IPO stands for Initial Public Offering, which is when a private company sells stock to the public for the first time. Companies go public to raise money and give early investors and employees a way to sell their shares. IPOs are hyped as opportunities to get in early, but research shows most IPOs underperform the market in the first few years. According to a University of Florida study, IPOs underperform the market by about 3% annually over 5 years. The exceptions get all the attention, like Amazon or Google, but most IPOs are mediocre investments. Stock splits happen when a company increases the number of shares and decreases the price proportionally. A 2-for-1 split means you now own twice as many shares worth half as much each. If you owned 100 shares at $100, after a split, you own 200 shares at $50. Your total value doesn't change. Companies do this to make shares more affordable for small investors, though with fractional shares now widely available, this matters less than it used to. Reverse splits are the opposite. The company reduces the number of shares and increases the price. A 1-for-10 reverse split means you now own 1/10 as many shares worth 10 times as much each. Companies do this when their stock price is very low and they're at risk of being delisted from major exchanges. Reverse splits are often a red flag that the company is struggling. Annual reports and quarterly earnings calls are where companies disclose their financial performance. The annual report, called the 10K, is a detailed document covering everything about the business. Quarterly reports, called 10Qs, are shorter updates every 3 months. Earnings calls are when company executives discuss results with analysts. All of this is public information. If you own stock in a company and you've never read their 10K, you don't really know what you own. Insider trading is when someone buys or sells stock based on material, non-public information. If you're a company executive and you know your company is about to report terrible earnings, and you sell your stock before that news becomes public, that's illegal insider trading. However, insiders can legally buy and sell their company's stock. They just have to report it publicly. Tracking insider buying and selling can be useful. If lots of executives are buying stock with their own money, that's usually a good sign. If they're all selling, that might be a warning. Proxy voting is your right as a shareholder to vote on company matters like electing board members or approving executive compensation. Most small investors ignore this, but it's technically part of ownership. Activist investors buy large positions and use their voting power to push for changes. The wash sale rule is a tax regulation you need to know. If you sell a stock at a loss and buy the same stock or something substantially identical within 30 days before or after the sale, you can't claim the tax deduction for that loss. This prevents people from selling at a loss for tax purposes and immediately buying back the same stock. Blue chip stocks are shares of large, well-established, financially stable companies with a history of reliable performance. Think companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. These are generally considered safer, less volatile investments. Penny stocks are stocks trading for less than $5 per share, usually in small, speculative companies. They're incredibly risky because they're often thinly traded, easy to manipulate, and the companies behind them frequently fail. Beginners are attracted to penny stocks because they think turning a $1 stock into a $2 stock is easier than a $100 stock into a $200 stock. But that's not how it works. Most penny stocks go to zero. Growth stocks are companies expected to grow revenue and earnings faster than the average company. They usually don't pay dividends because they reinvest all profits into expansion. Tech companies are often growth stocks. The bet is that rapid growth will lead to much higher stock prices. Value stocks are companies trading below what investors believe they're actually worth based on fundamentals. They often pay dividends and are in mature industries. The bet is that the market is undervaluing them and will eventually recognize their true worth. Cyclical stocks are companies whose performance is tied to the economic cycle. When the economy is booming, cyclical stocks like airlines, hotels, and construction companies do great. When the economy slumps, they suffer. Defensive stocks are the opposite. Companies that perform relatively steadily regardless of the economy, like utilities and consumer staples. The expense ratio is the annual fee charged by mutual funds and ETFs, expressed as a percentage of your investment. A 0.5% expense ratio means you pay $5 per year for every $1,000 invested. Index funds often have expense ratios below 0.1%. Actively managed funds might charge 1% or more. Over decades, these fees compound and make an enormous difference. Market timing is trying to predict when to buy and sell based on where you think the market is headed. Study after study shows this doesn't work consistently. A famous Fidelity study found that the best performing investors were people who forgot they had accounts. They didn't tinker, they didn't try to time anything, they just stayed invested. The second best performers were dead people whose accounts just sat there untouched. The S&P 500 is the most widely followed stock market index, representing 500 of the largest US companies. It's weighted by market cap, so bigger companies have more influence. When people say the market was up or down today, they're usually referring to the S&P 500. The Dow Jones Industrial Average is another major index, but it only includes 30 large companies, and it's price-weighted, which is kind of outdated. The NASDAQ composite is tech-heavy and includes more than 3,000 stocks. Now, here's what you actually need to do with all this information. First, open a brokerage account if you haven't already. Fidelity, Vanguard, Charles Schwab, these are all reputable and charge zero commissions on stock trades. Second, start with index funds. If you're completely new, put your money in a total stock market index fund or an S&P 500 index fund. You'll own hundreds or thousands of companies instantly, you'll pay almost nothing in fees, and you'll outperform most professional investors over time. Third, automate your investing. Set up automatic transfers from your checking account to your brokerage account every month. This removes the emotion and builds the habit. Fourth, increase your contributions over time. Maybe you start with $100 per month. When you get a raise, bump it to $150. The goal is to gradually increase how much you're investing as your income grows. Fifth, ignore the noise. Financial media makes money from your attention, so they're constantly screaming about market crashes and hot stock tips. Turn it off. Check your portfolio maybe once a quarter, not once a day. 6, keep learning. You now understand more stock market terms than 90% of people, but there's always more to learn about business, economics, psychology, tax strategy. Here's the hard truth. The stock market is one of the most reliable wealth-building tools available to regular people, but only if you actually use it. You can watch this video, feel motivated, and then do nothing. Or you can open an account this week, invest your first $100, and start building real wealth. The terms don't matter if you never take action. The math doesn't matter if your money stays in a checking account earning 0.01% interest while inflation eats away at it. Every single person who has built wealth through investing started exactly where you are right now, confused and unsure. The difference is they started anyway. They bought their first share, even though they didn't understand everything. They kept investing, even when the market crashed and it felt terrifying. And 20 years later, they have financial freedom while their friends who waited for the perfect time to start are still waiting. You have all the knowledge you need to start. You understand what a stock is, how markets work,